Hi everyone, welcome to the second episode of Savart podcast, Markets and Beyond, where we decode wealth for all. Today we have Mr. Niraj Dugar, the founder of Holistic Prime Wealth India, who has 15 plus years of experience in the financial markets and is a credit card expert. Hi Niraj, thank you for being here today.
Hey Suraj, thank you for inviting me.
Okay, so yes, Niraj, I would like to ask you a few questions. And to begin with, you have spent more than 15 years in financial planning, right? How did your journey begin and what drew you towards this profession?
So, Suraj, I am a chartered accountant by qualification, and I don't have 15 years of experience in financial planning. It's 6-7 years of experience in financial planning, but my work experience spans more than 15 years. And just before my CA exams, my father had passed away. And I had to write my exams after that. I cleared that and then started looking at family finances because all of the responsibility to manage family finances fell on me. And once I started doing that, I over time figured that the basics were not taken care of by my father. And then I figured that when I was working in companies like Grant Thornton, Deloitte, etc. I figured that most chartered accountants also do not have an idea of how to manage their own money, right? And that's what motivated me and inspired me to set up my own practice, because I wanted to help people, obviously, and I enjoyed doing this more than what I was doing at those firms. So I worked there for 6-7 years, started simultaneously was learning about personal finance, implementing it in my own finances, making a lot of mistakes and figuring out what works, what not works and what does not work. And then in 2020, I started this practice of my own. And right now I work with a partner of mine his name is Nishant, and we are equal partners in the business, and both of us merged our businesses on 1st of January 2022.
Okay, that's nice and good to know about your journey. But I'm sure it was pretty tough to begin with because financial planning was not known to many people back in the day, right? When you started, though it's not long time back, but still, like people were still very new to the whole financial planning part. How tough was it? Like challenges that you faced?
Yeah, so absolutely, you are right. That financial planning was unknown, and even when I was doing it in the early years, right, it was not very apparent that I'm doing something called financial planning. I was looking at things on an isolated manner. Say, for example, having a life insurance, right? So when my father passed away, we got like 10 lakh rupees of a claim from LIC. And I figured that he had already paid 5 lakh rupees in premium, so we got like 10 lakh rupees, so double of what he had paid. But then I figured that there is something called a term insurance, where you get an insurance of 1 crore and above, depending on your income, at a very low cost. And my father did not have that, because if he had that, then we wouldn't have struggled a lot even after his death, immediately after his death, right, financially. So then same with health insurance and same with investments, right? So eventually I started figuring out these things on an isolated manner, and then figured that yes, this is all a part of the financial planning package, right? So that's how my journey began.
Now that you brought insurance up, I mean, that was something I wanted to ask, but now that you brought it up, I'll actually ask it right now. So a lot of people have this confusion between term insurance and life insurance and health insurance. Can you just put it in baskets for us to understand and for our viewers to understand as well?
Absolutely. So firstly, we need to define what exactly insurance is. Most people don't really know the definition of insurance. So when you ask your family members, my family members, कि insurance है क्या आपके पास, they only know one type of insurance, which is mediclaim. They don't even call it a health insurance, they'll call it a mediclaim. And when you ask them about life insurance, they'll be like, acha, LIC.
Exactly.
Right?
I was just going to say that.
Yeah, so they will, the markets, the financial, firstly, we have to understand that financial markets have been structured in a way wherein it is more beneficial for the manufacturer of the products and seller of the products, right? So what was good for people was never told them or taught them. Now we have a lot of campaigns like Insurance Sahi Hai, right? So coming back, to the drawing board. So firstly, what exactly is insurance? Insurance is just a cover for our risk, right?
Yeah.
And as an individual, what kind of risk do we have on a daily basis? Think about it. Can you tell me a couple?
I mean, firstly, medical, of course, I guess I'm coming from the same kind of a mindset, which may be wrong. It can be medical, it can be death of somebody in the family where people can be protected, the ones who are left behind.
So, primarily 4 types of insurance covers is what one needs, and because of those risks. So, we'll talk about each of them individually. So, the first one is a health insurance, obviously, right? Because if you fall sick, you get hospitalized. You don't want to pay that hospital bill from your pocket, right? So health insurance will take care of that. And now we'll talk about having an employer insurance versus own insurance later. Then you have your life insurance. Life insurance is, so firstly, when do you need a life insurance? Okay, you need a life insurance when you have dependents. So in my case, I have my son who is a dependent on me, right? So my wife also is employed, so she's not dependent on me. My mother is partially dependent on me, right? So I have these 2 dependents on me. You may have your parents, your wife, your kids, etc. on dependent on you. So if you have dependents, you need a term insurance. That's criteria number 1. Criteria number 2 is, are you going to create dependents in the future? Then you can buy a term insurance today. Now, what people do when it comes to life insurance is they think that they should get their money back at the end of the term. Okay, the premiums that they've been paying, they should get it back at the end of the term, because that's what LIC has taught them. But one thing to understand is insurance is not a product which should give you any return of your money. Okay, insurance is not an investment product. Okay, when you Google the definition of insurance, you will not see the word investment in it. So remove the word investment from your mind when you think about insurance, right? So life insurance, a pure risk cover. Now, for example, so you understand this, right? So let's say you're earning 20 lakh rupees a year, and family's expenses are 12 lakh rupees a year, and you have 2 kids, and you need to send them to colleges, and also prepare for your retirement. You may also have an home loan. So how much approximately should be your term cover? The maximum eligibility is 2.5 to 3 crores. Okay, so 25 times of your.
Got it.
Yeah, so you will need. So if you need, so say for example, if
75 lakhs probably.
75 lakhs is very low.
Oh, okay.
Okay, so if you're spending 12 lakh rupees a year today, okay, and if you're going to retire after 20 years, you will need a corpus of approximately. So 12 lakhs, you compound it into 20 years in the future, which is approximately 4 doubles. So 80 lakh rupees per year is what you will be spending, right? And then based on that, you calculate your retirement corpus number.
Got it.
Okay, so it's not going to be just 75 lakhs. It's going to be in crores, and then you need to provide for your kids' education as well. So that's why. You either take insurance based on your eligibility or based on how much you need, depending on whichever is lower. So just to give you an example, my personal life insurance cover is 5.5 crores, right? So this is the whole idea. So I bought my first 2 crores of insurance cover when I was 25 years old, and I purchased another 3.5 crores last month.
Oh, wow, nice.
Right. So then the third insurance is accident cover.
Yeah.
Okay. So you play sports, or you do long distance running, or you ride 2-wheelers a lot, the likelihood of meeting with an accident is high. So if that is high, then you need an accident cover, because these accident policies will pay a lump sum on I'm sorry, what is it called? Disability. Yeah. These accident policies will pay a lump sum on disability. Now, there are 2 types of disability: permanent total disability and permanent partial disability. Permanent total disability means loss of 2 hands, loss of 2 legs, loss of eyesight in both the eyes, and so on. And partial is half. Yeah. You will get a lump sum payout. So I do long distance running, so I purchased a 1 crore accident cover, right? And it's a very cheap product. And the last insurance that one needs is a critical illness cover. This policy will pay out a lump sum on diagnosis of a critical illness like cancer, for example. So these are the only 4 products you need. First 2 are should be your priority. Last two, optional.
Got it. Okay. I guess that is really well explained, Neeraj. And I guess even for our viewers, I don't think so. They know, or they might not be knowing so much about insurance and the way you explained it. Thank you so much for that. And I would just go back in time a little. I want to understand, after CA, you mentioned that you got into financial planning and all of that. So how was your journey like? If you can walk me through it. I mean, did you do some kind of a course or some kind of certification? How did you get into it?
I did not do any courses for that because I already had a decent understanding of finances because of my background and qualification, right? So I didn't really need to do courses. So what I learned everything, from personal experiences, right? Like I said, like I gave the term insurance example earlier, and then same with health insurance, right? So I figured that the policy that my father had was not continued, so it had lapsed. Now, and then my grandparents also were alive at that time, right? And they also started needing hospitalization and healthcare and all that. So when they were getting admitted, then I figured that they also don't have a health insurance and we have to pay so much money out of pocket and they are not eligible. So then I understood that you need a health insurance when you are healthy and early in life, and a bigger policy, not a smaller policy, because you want to keep that policy for the rest of your life.
Exactly.
Right? So people think that a 10 lakhs cover is going to be very, very comfortable for me for the rest of my life, right? But just to give you an example, a couple of months back, a client of ours got admitted in a hospital for fever. And doctors were not able to figure out the reason for the fever. Ultimately, they could figure out, but he had to stay in the hospital for 12 days. And his bill was 8 lakh rupees just for fever. Now you imagine, if something worse happens and you have to stay in the hospital for 15, 20 days and also include a surgery in that, the bills are going to be massive. And also adjust this for inflation. I'm 35, you are younger than me. So you will need insurance for the rest of your life. And if healthcare inflation is in double digits, which means that the costs are doubling every 5 years.
Yeah.
So personally, I have a health insurance cover of 1 crore for myself and 75 lakhs for my wife.
Okay, Neeraj. So Neeraj, I want to get into the financial planning side of things now. So there is a mindset amongst people that financial planning is mainly for the wealthy. And why do you think this mindset exists amongst people? And if it does, is it true or not?
So it is primarily because of the background that we are coming from. Okay, why did people not focus on financial planning before our generation? Is largely because most of our parents had government jobs, and they are receiving pensions today, right? But none of us are going to receive any pension. Even the government employees, they will not receive any pension. Whatever corpus they create in national pension scheme will be paid out to them, right? So they are not going to get pension and increments over time like our parents received. So that is the major reason why people never focused on financial planning, because your finances were covered. You would get a flow of money every month. You would get healthcare, right? What else do you need? You would have already purchased your house during your earning year. So you and your kids would be educated, right? So you really didn't need much. But now those things have changed. And coming to the point of whether rich and wealthy people need financial planning versus a middle class person, you think about it like this. There was this politician recently in the south. There was a big noise about him having a couple of 100 crores in his bank account. That guy doesn't need financial planning because he can survive on that 200 crores with in bank with he can survive with that 200 crores in his bank account, right? He doesn't need financial planning.
Generations
Sure, if
can
he can,
survive
yeah,
easily.
generations can survive, right? But if he deployed that money in a better manner, definitely he can create more wealth out of it. He can grow it better, right? But someone who is living on paycheck to paycheck today and has an end date to his career definitely needs financial planning. If you are employed or salaried, you are not going to receive pension from Government of India. You are not going to do your own business. You have kids who want to be educated either outside India or in good colleges in India, you want to retire comfortably, you want to live in a better house than where you are staying today, you need financial planning. There is no question about it, right? And which is most people don't really understand, or by the time they understand, it's very late in their life.
Fair enough, yeah. So I want you to tell if there is a formula that you would like to give to the young people, or any advice to the young folks who are just starting the investment journey. Is there something that you want to address to them?
So younger people, you see last few years on social media, a lot of influencers came up who started selling returns, right? High double-digit returns, triple-digit returns in various products across the world. Now, the problem with that is that firstly, it is not sustainable. Okay, you can't really compound your wealth at 30, 40, 50% for decades. You may get lucky for a few years, but that's it. Okay, you can take anybody, right? Take Warren Buffett, for example. His compounding rate for 70 plus years is only 19%, right? Which is on the higher side because he is Warren Buffett. But for normal folks, it's not going to be that much, right? It's going to be somewhere between 12 to 14% if deployed correctly. So the problem is that when you are young, you are not earning a lot of money and you don't really have a lot of surplus to invest. So if you are making even a modest salary of 1 lakh rupees per month in hand, and you can save 30-40,000 from that, and you invest that, at the end of 1 year, you only have 5 lakh rupees. So if you have 5 lakh rupees at the end of 1 year, you generate 50% return on that. That's just 2.5 lakh rupees. But if you can get to a corpus of 1 crore and generate 12% on that, that's 12 lakh rupees. So most people fail to understand that you need capital to create wealth, and capital is only going to come from your own income. Markets are not going to do that for you. And if you can double your income as fast as possible, that is the magic, that will change your life.
But again, see, sorry to interrupt you here. You've been talking, I mean, you just mentioned about somebody who's earning probably 1 lakh per month. What about somebody who's probably just started working, just fresh out of college, is 23, 22, 23, who's probably earning 50, 60,000 per month? What about that? Where does he stand with the whole investment journey of his?
So this guy, if the person is earning only 50, 60,000 per month, how much room do you think will he have to save and invest?
Okay, so even if you think like 5,000, 6,000 per month, do you think that is a good number to start with or not?
Any number is good to start, but my advice would be to first cover your insurance requirements. So buy that health insurance policy and your term insurance policy, build some emergency fund, and then use the money instead of investing to upskill yourself and figure out how can my 60,000 per month become 2 lakhs per month, 5 lakhs per month, and 8 lakhs per month. Trust me, you investing 2,000-3,000 rupees per month is not going to do anything for you until and unless you think that my income is only going to grow at 5% or 7% per year and I'm comfortable with it. Sure, you invest the balance, right? Basically you've decided that you're not going to work hard and increase your income, right? So that's the challenge. And I have seen people they're comfortable with their jobs and they're comfortable with having a salary increment of 5 to 7%. Then your retirement is also going to be in the same way. You have to you can't really hope to live a comfortable retirement or a lavish retirement versus somebody who is working hard to make more money.
Okay. Got it. Yeah. So again, just speaking about the same point, for again somebody who is starting off fresh, what matters more, growing your income or chasing high returns? What do you think should be a priority?
Absolutely growing your income, right? Even today, at the age of 36, my focus is continuously on growing my income. It is not on maximizing returns. I am 100% comfortable with 12 to 14% returns on my portfolio. Because my portfolio size itself is so big that it adds, even at 12% return, it will add a sizable amount of capital to my wealth.
Fair enough.
And I just have to double my money every 5 to 6 years. I am not chasing returns. I am chasing growth in income. Can I double my income in the next 3 years is the question. Because my base is higher, I am saying 3 years. If my base was lower, I would have said 2 years. And I figured this very late in life. Okay, this is not something that I figured early in life. If you told me that focus on increasing income at the age of 22, I would have just done that. I figured this around the age of 30.
So what were you chasing? Were you also chasing returns? At 22?
Absolutely, yes. In my early years, I did chase returns. I have done F&O. I have done small cap investing, micro cap investing. I have purchased advisory services of multiple advisors.
Oh, wow.
Right. So
how did that pan out? I mean, if you don't mind me asking.
It obviously did not pan out well, right?
Yeah.
In the end, markets teach you life-lasting lessons, right? It is up to you whether you are able to learn from that or not. Just for example, in 2017 we had a massive small cap rally. All my money was invested in small cap. I did not exit on time, right? And these were direct stocks. I did not exit on time, and I saw that crash also in 2018. And then I figured that, okay, this is not the way to invest your money, right? And my temperament is not meant for buying stocks. My temperament is to invest in mutual funds, right? So from then onwards, I moved everything to mutual funds. I don't buy any stocks on my own. What I learned was that if I put 5 lakh rupees in a stock, and even if that goes 10x, it's not going to change my life again. Because the likelihood of that happening itself is very, very low.
Yeah.
Right? And the amount of time that I need to spend to figure that stock versus me spending that time on earning more money, you have to, see which is more beneficial.
Yeah.
So I have always been of the view that anyone at any level of wealth, sure, once you've had, accumulated a sizable wealth, then you can decide, okay, is this enough money for you, or do you want to create wealth, continue to create wealth out of it? So you can take examples of big investors who have done that, converted their 4-5 crores to 100, 200, 500 crores. And then there are people who are comfortable with 8 to 10 crores and they've retired, right? So
yes,
that is a call that you need to take personally.
Yeah. I hope this answers a lot of questions that the youth have been watching our podcast about. So the main reason is because, as you realize this in your 30s, right? A lot of times you see the youth, probably in their late teens and early 20s would be having the FOMO, quite certainly the Gen Z FOMO kind of a situation where they are chasing higher returns or comparing their portfolio with their friends and trying to get into the whole F&O and intraday and all of that.
Yeah, so couple of things here, right? So when you chase higher returns, let's take real estate, for example.
Yeah.
Okay, a lot of people, what they do is they flip real estate.
Yeah.
Right? They will buy today and sell it at a profit after a year or a couple of years. And they'll use leverage and all that. The problem with this whole idea of flipping is that unless you build a portfolio of real estate and you just take concentrated bets of, investing money in a single piece of real estate and then flipping that, one fine day you will get stuck.
Yeah,
because
it's nothing but like money rotation as well, right?
It is money. No, sure, that's fine. But what happens is, say I bought one property A today, I sold it at a profit. Then I bought B, sold that at a profit. Bought C, sold that at a profit. When I bought D, I got stuck in that property because the builder couldn't deliver.
Yeah.
There were some issues because of their compliances. Markets crashed. And my money got stuck, right? So your overall long-term returns came down significantly at what you would generate without doing all that exercise anyways.
And your cash is also stuck in a
And cash
place.
is stuck now, right? So these things people don't understand. Because once they have a good experience, they think that I will continue to have this good experience forever. And the same thing happens in F&O. Even if beginner's luck favors you and you make some money in F&O in the early days, then you think that I am the king and I will continue to make money, and one fine day markets will teach you that lesson.
So do you agree with me if I would say that F&O is nothing but legalized gambling?
To an extent, yes. For most people, yes. But then people who understand these markets very well, who understand risk management, who understand position sizing, for them it's a full-time business.
Yeah, of course.
And if you can do it on a full-time basis, then you can definitely make money from it. But the most important thing that you need to understand is risk management, position sizing, and when to stop and reduce your bets. Which only you've seen data from SEBI, right, which says that more than 90% people lose money in F&O is for a primary reason, because less than 10% people consider it as a full-time business and run it as a business, right? Everyone else is chasing multiplication of wealth only.
I guess a lot of people with time have realized that F&O is kind of risky and they should focus towards long-term capital, building the wealth for a long term.
So that is also true. Like for example, we work with almost 300 families, right? We help them with their financial planning, wealth management, etc. Less than 1% of families engage in F&O or such speculative activities because they've understood how wealth is going to get created, right? And I'm sure this is becoming largely true across India.
Yeah, because again, so many times that has happened with us in Savart as well, where people have come literally crying and being totally depressed and shattered that they have invested money in F&O. And initially, as you said, the beginner's luck favored them and they made a good chunk of money. And then suddenly they really got humbled by the market, I would say. I guess humbled would be an understatement, but they were so shattered because a lot of their money got lost because of F&O. And then they realized that it is important to invest for a long term and be patient.
Correct. So even of the best of the traders, if you talk to them, okay, the ones who really do it seriously and ask them what is their expected returns from all the F&O activity that they do, they will say it's around 2% a month. Which is 24% annualized.
Yeah.
And 24% annualized after doing it on a full-time basis.
Exactly.
Right? Now, if you just invested in mutual funds, you would still make anywhere between 12 to 15%, not on the short term.
And you won't have that headache.
You won't have that stress, and you can probably increase your income by more than 10%. If you can do that, then your annual returns have increased sizably, right?
Fair enough.
So this is where I ask most people to focus on achieving average returns, but be extraordinary in terms of how much time you can remain invested in the markets and how fast you can grow your income.
Niraj, I had a doubt. You see a lot of Indians having a huge amount of money in their bank account, be that for current or savings account, right? So what do you think is the correct number to be invested in the market? Like, is there a proper number? Do you have any math behind it? The reason again is that because I guess Indians are coming from that mindset where they would like to see that cash in their account. I mean, earlier it was more about having cash in their cupboards, but after demonetization, I guess they still won't have it in the account, but it should be visible to them.
So people have this sense of comfort when they see money in their bank accounts, right?
Especially, I guess, people who are near retirement or who have just retired or something of that sort.
Can you guess how much money is in my bank account right now?
Okay, you need to give me a hint on that.
You guess. Take a wild guess.
3 lakhs?
It's less than 10,000 rupees.
Wow.
I don't keep any money in my bank account.
Okay.
Firstly, it is prone to frauds, right?
Yeah.
We've seen frauds happening with our family members as well, right?
Yeah.
I have seen personally something happening. You know, my mother-in-law losing money, one of my buas losing money. We did get a part of it back, but we've lost money, right?
I guess in this day and age, especially, there have been so many web series made on such frauds as well.
Yeah. So I don't like to keep money in bank accounts. That's reason number one. Reason number two, you only get 3% returns on the money that's sit in your bank account, right? And that also is taxable, by the way.
Yeah.
By just moving it to a debt mutual fund, okay, you make 6.5% returns, and on a post-tax basis, you make 4.5% returns, even if you are in the highest tax bracket, right? And thirdly, if I have an emergency fund set aside, I don't want. Why should I keep a lot of money in my bank account? My money should be working for me, which means that I want to invest it in places where I can earn inflation-beating returns.
Fair enough.
So if I have to earn inflation-beating returns, it has to go into a volatile instrument. It can be equity, it can be gold, it can be real estate, right? So my money is not going to sit in a bank account or in fixed deposit. Why do people like to keep it? Because firstly, they don't really know what to do with it. Okay, they probably have earned more than what they needed, and they just let it be in the bank account, or they are unaware of the options that are available for them,
Fair
right?
enough.
And they are very comfortable paying taxes also on that. Like we've had clients come in over the years with crores sitting in fixed deposits and 10, 20, 40, 50 lakhs sitting in their bank accounts. And once we explained them that you are paying so much taxes and your post-tax return is only less than inflation in case of an FD and less than 2% in case of money sitting in savings account, they understood and they started moving money to mutual funds.
How tough was it to convince people? Because when, people come with such huge numbers, they have very rigid mindset, right? It's tough to break the rigid mindset.
So it is still tougher. So what you do is help them figure this out over a period of time, right? Don't push them to invest it immediately. Okay, maybe 5% or 10% of what is already with them. Start with that. Let them experience that investment. Let them understand the whole process, and then over time move the entire money to these kind of buckets, right? So ideally, when you are an active, when you have an active income, the only taxable income that should hit in your bank account is your salary. That's it. Right? If you think that a 30-year-old shouldn't even be thinking about creating passive income. Okay, passive income is probably the biggest fraud that's being sold in India and worldwide.
So passive income, do you mean multiple sources of income, or
it could be, say, for example, you buying a bond at a 12% IRR, okay, and that interest getting paid out every year. If you are salaried, you have to pay tax on that interest income also, and then you don't really understand the risk involved in buying that bond as well, right? So rental income is another example. Right. So sure, you can create rental income. That's probably still okay because the effective tax rate is lower, but you have to understand the amount of money that gets locked in real estate and the yields that you generate on the rental income. These are all very complicated stuff, and you probably not make even as much as FD. So younger people in the middle ages who have an active income should not really focus on having any other income hitting their bank account because it's taxable. Don't keep a lot of money in your bank account. So ideal thumb rule that I ask people is to keep like 1 month worth of expenses in your bank account. It can be in a sweep in fixed deposit as well. That's also okay. So 1 month worth of expenses in a bank account, then 4-5 months to like 10-12 months of expenses in emergency funds through mutual funds. And obviously credit card is also there as a third line of credit for you.
Yeah. Got it. No. That has really given me a good amount of clarity, I guess. And even for our viewers who have tons and lakhs and crores of rupees in the bank account, guys, please be careful. So what do you think is one habit that every Indian family should adopt? Like if there's any advice you would give them or anything, any good habit?
So they need to get comfortable with equity as an asset class. Okay. Almost all Indian families are comfortable with real estate.
Yeah.
They're comfortable with gold.
They're more than comfortable with real estate and gold. Yeah.
And they're more comfortable with physical gold versus gold ETF.
Exactly.
Okay. So basically, they're comfortable with hard assets and they're not comfortable with financial assets.
That's, I guess, because they can touch and feel, and that is important to them.
And they don't really check the prices on a day-to-day basis.
Yeah.
Okay. So you might have seen your family, your parents buying gold every Diwali, gold or silver, and then keeping that for years, right?
That's hidden in a locker somewhere as a treasured
right?
possession.
And have they ever bothered about selling that?
Never.
No. Even that discussion is a taboo.
Exactly.
Right? So I have had these discussions with my mother, and she would just say, "तेरा दिमाग खराब है क्या? घर की ली हुई चीज कोई बेचता है क्या?" But that mindset you will never see that mindset with equity.
Yeah.
Because after 2020 especially, everything is available, on your phone. So the moment you wake up, you start seeing those markets, and every 10 minutes or 15 minutes you see how are your stock prices moving or how is the market moving. So if as of today, gold has crashed by more than almost 30%, okay, in dollar terms. Not so much in INR terms because of the import duties that got added recently, but in dollar terms, gold has crashed by more than 30%. Did you have a discussion at home where your mother is saying that gold kitna gir gaya, बेच देना था $5,500 में, right?
There's only a discussion when they read in the newspaper, probably our parents, that gold has gone up. They feel a sense of comfort that, "Arey, we bought it at such a less price." And
और
look at
they
the
will
price
say कि
now.
ज़्यादा खरीद लेना था तब.
ज़्यादा खरीद ले. Or they'll think either that now that it's rising, let us invest more.
So my mother keeps saying कि जब तू छोटा था गोल्ड सिर्फ 3,000 रुपए में मिलता था, right? But they don't realize the concept of annualized returns, the concept of liquidity in finances, and a lot of other things. So the same thing when you compare return of gold versus return of equity markets. Until 2024, equity markets were doing well. Until 3 months back, gold was doing well. Now maybe they are at par probably, or equity markets have come forward again. But the whole point is that you apply the same mindset to equity markets, which you apply to gold and real estate, because you have to create a retirement corpus for yourself. You have to create a healthcare corpus for yourself, corpus for education of your kids, right? And that's not going to happen through real estate or gold. If you buy a real estate, so recently we're having a discussion with a client who bought a real estate worth 70 lakh rupees, and he said that I bought it because I will sell it when I need it for my kids' education. So then I asked him a simple question. I showed him the math that he needs. If he has to send his child outside India to study, he will need around 3+ crores for 4 years of education after 10-12 years. I asked him a simple question. Will you be able to sell this property at 2.5 crores, at 2.8 crores, okay, after 12 years? And he said, no, not possible. And do you understand? So what was the math behind this? I was just doubling the value of the property every 6 years at 12% rate of return. So 70 becomes 140 in 6 years, and 140 becomes 2.8 crores in another 6 years. So 12 years mein your property becomes 2.8 crores, and that is the corpus that you need for your education, for your child's education. He said, no, not possible. He said like 1.5 crore ke beech mein bik jayega. So people don't even, they are not able to figure out ki when I'm investing my money, how much return will I make from this?
Fair enough.
Okay. And
so
when
the same money, if you would have invested in the market in a safe manner, not being too risky about it, what kind of return would he be expecting?
So you just take the assumption of nominal GDP growth here, right? So if India is going to grow at 10-11% on nominal basis, that should be your assumption when you're investing in equity. Sure, you will take a diversified portfolio. Sure, you will invest in actively managed funds and try to beat that. You can add a couple of more percentage points to that. But your base case assumption should be that I will earn 10-11% from the markets and then work from there.
7 lakhs into 10-11 per annum, percent per annum into 12 years would be how much?
That would be 2.8 crores. That's if you invested that 70 lakhs in the markets, right? You would probably, there is a very good chance of that money becoming 2.5 to 3 crores in 12 years.
Got it.
So that's the whole point which is missing right now, is that we are not able to stay invested in the markets the same way we have been, invested in real estate and gold. So you see the historic returns of any markets, American markets, Indian markets, they have been very good, right? Last 2 years, markets have not done well, but there have been so many phases where markets have not done well, right? So, but all of us get anchored to recent history only and recent past. So everybody was talking about gold and silver in December and January. Now they're swearing against it. Silver has fallen by 50% or more. Now everybody is talking about global investing. Global investing is the theme in India, right? So people just want to latch on to trends at the end of that trend. If your friends, your family members have started talking about investing in something, assume that it's the end of that story. We got a client right on 27-28 January asking us to invest his money in gold, right? And that was the top, and we told him, don't invest, boss. This is not the time to invest.
I remember there was a shortage of physical silver.
Gold and silver.
No, silver
Yeah.
in particular during the Diwali time. I remember there were people long queues as though
Massive
people
shortages, massive gold. And
I
you would have
find-
heard कि silver 6 lakh जाएगा, 8 lakh
Yeah.
जाएगा.
Not only that, I have seen people standing outside the jewelry stores as though there was free silver that was available to them. That was shocking.
And did you hear stories कि silver has EV applications and solar applications? That's why silver demand is only going to rise, and that's why silver price is going to only go up. People don't see. You have to understand one thing, okay? If anything has an industrial application, okay, and if the price of that commodity goes up, the demand will go down.
Yeah.
Oil is a great example of that. If oil prices go up, demand will come down. Okay.
Yeah.
So the price of that commodity cannot continue to stay up. Gold remains up and structurally goes up because it's not a industrial commodity. It's an investment commodity. It's a wealth preservation commodity. Silver is not that.
What do you think, honestly? I've asked a lot of market experts this question. Do you think that the gold prices are going to go up or not?
I don't have a view on the prices, but if you were to ask me, should you allocate to gold? I would say yes.
And
how
but in the
much?
form of ETF, right?
Both are fine, actually. Physical also is fine, ETF also is fine. Whichever manner you are comfortable with. The problems of physical gold is that you have to pay GST on the gold that you purchase. You have to put it in a locker, safe keep that gold and pay locker rent, etc. You have to be comfortable with those things, right? Otherwise, ETFs are perfectly fine.
So you're not against buying physical gold or any of that sort?
Personally, most of my gold allocation is through physical gold only.
Okay. Okay, so moving towards, we have covered the aged people who are close to retirement or who are retired. We have covered the people who are just starting the investment. Now I want to talk to you about the couples, right? Couples mainly in this day and age, again, have a problem between them because of friction of money. So how do you think they should take care of their investments or their finances, like their money management? How should that be? Maybe you can think about a young couple in your mind before answering this question.
So I generally, like to take examples from history and learn from them, right? And our own families are great examples of finances, personal finances, right? So I have seen people in my family, husband and wife fighting over money, right? Even my mother and father would fight over money. This was primarily because one person was earning and one person was taking care of the house. And now times have changed and both are earning, right? But so you need to really, if you want to, if you want your relationship to sustain till the end of your life, you really need to be comfortable with money, between the husband and wife, right? So what we personally do, I can only tell you that, and why do we do that, I'll tell you that. So for my wife and I, everything is a family, is family finances. There is no your finances and my finances, okay? So she doesn't bother where her money gets invested or spent. I don't bother where my money gets invested or spent. At the end of the day, it's a common pool. We are, investing towards a common pool. So what are these common pools? Wealth creation and investing for kids' education, right? So we have decided that we will invest a set amount of money every month. Once that money gets debited, after that, whatever is left, we spend it on wherever we like, right? It will be household expenses and discretionary expenses. It can come from anybody's bucket. What we do is we've decided a set amount of SIP that will debit from her account and the set amount of SIP that will debit from my account. उसके बाद तुमने इसमें पैसे क्यों खर्चा और मैंने इसमें क्यों खर्चा, those questions will never arise. If she wants to spend money, she can do it. Okay, we've decided a threshold कि above a certain amount only we will discuss spending money on a particular thing. So we've set that threshold at 10,000 rupees today. So if she has to spend less than 10,000 rupees, she doesn't even have to ask me. And same is my rule as well, right? I will not ask her if I have to spend less than 10,000 rupees. More than 10,000, both of us discuss. Once we agree, then only we spend, right? It can be for her requirement, my requirement, common requirement. It can be anything, right? So that's how we have set it up. And I have seen many families, many couples, even the younger ones and people in their 30s, they are keeping their finances separate. A lot of them also keep, their financial advisors separate.
Oh, wow. Okay.
Right? So they don't even want the other person to know how much money they are making and how much investments they have. And this is true not only for people who are making less amount of money, it's true for people who have more than enough, which will last generations, right? So this mental mindset, unless it goes away, it's very difficult. I can't really explain it, why do they do that, but it's basically some sort of insecurity in their minds because of which they do it, and it should not be there. Once you remove this, you see life is beautiful.
Okay. A lot of people are earning more in their 30s than in their 20s or when they just started earning, right? And even in 30s, they feel they're broke, right? How do you think we can sort this problem out for them?
So the best way to solve this problem is to start early. Okay, so there
Early investing or early earning?
Saving money early.
Okay.
Right. So
that can even be pocket money from parents or anything of that sort.
If you can do that, if you can teach your kids to start saving their pocket money, it's excellent, right?
Yeah.
I'll come to that point, but once you start making money, okay, if you don't start saving and investing in your 20s, you'll probably not do that in your 30s.
Yeah.
Because it's all about habit.
Hmm.
Okay, and building that habit muscle takes a lot of time.
Hmm.
If you don't invest in 20s, you will be of the view that abhi to income hai nahi.
Hmm.
When my income increases, I'll be saving more. But they don't think about the they don't think about lifestyle inflation.
Yeah.
Okay, because as their income grows, their wants will also grow.
Except that's
and
basic.
That surplus is never going to come.
Yeah, it's basic economics, right?
Yeah, right. So you have to start somewhere. The earlier you start, the better it is for you, because not only your money will get enough time to compound, you will always have that habit of saving some money, and you would always want to save more money than what you saved in the previous year. Right? This itself can do wonders for your finances. If you can save 15 to 25% of your monthly income, okay, for long term, for the next 20, 30 years, that is more than enough. You don't really need to do much. And the worst of the diversified mutual fund will give you better returns than you investing and picking stocks directly, right? Coming to kids, the best way to do it is, as a parent, if your child is very young, set up an SIP account for them, set up an investment account for them, and start doing a very small amount of SIP, whatever you can afford. So I started my kids SIP from immediately after he was born. So he's 1 year old now, and 11 SIPs have already gone. Wow. Right? So what this is going to do is, once he starts understanding money, he can start tracking this, and he will understand the power of compounding and the power of saving money, right? And that itself is going to help you a lot in your life.
I guess I can correlate on that. I was kind of lucky, I would say that, because when I was born as well, like this was many, many years back, but my parents luckily had this thing where anybody comes to see you as you're a kid in Indian family, they love to give you cash or some kind of a gift, right? So they made sure that entire money of the gifts and all of that till probably I was 19, it used to go in a separate mutual fund kind of an SIP, that every time somebody gives a gift, I don't get the cash to spend, but it just goes into a saving account, which I got to know years later.
That's awesome. And you can see in that statement, right, the invested amount versus the current value. The current value would be in multiples of that invested amount today. That's just because of the power of compounding.
Yeah. Yes. So Niraj, I would like to ask you a question on NPS. Right. I mean, not a lot of people know about what NPS is. So I guess, can you explain a little bit about NPS?
So NPS is a retirement product, okay? Retirement product to pay you a lump sum and some monthly income after your retirement. Now, this is also a great tax saving tool which most people are unaware of. So now you might know that there is a new regime in income taxes versus old regime, right? And most people have started falling in the new regime now. Almost 90% of folks fall in the new regime. And in the new regime, there are not many ways to save taxes. NPS is one way of doing that. So if you can invest in NPS through your employer, okay, whatever contribution goes to NPS is not considered as a part of your income and is not taxed. So for example, so there are rules around it. So the rule says that if you're in the new tax regime, the maximum contribution can be 14% of your basic pay.
Okay.
And in the old tax regime, the maximum contribution can be 10% of your basic pay. This contribution has to go through your employer only. Like your PF contributions, same way, NPS also has to go through your employer only.
So how different is it from EPF?
So EPF as an investment gives you a fixed rate of
Yeah.
return, right?
There is no
NPS
increase in the money, right?
So basically, the current rate of return is 8.25%. So whatever money is invested, you will earn 8.25% on that. But when you invest in NPS, the money that gets invested, you can decide, do you want to invest in equity, which is stock markets, or fixed income, or through government bonds or corporate bonds, right? Now, within equity, the fund manager also has the flexibility to invest in gold and real estate investment trusts. So the idea is that you invest in NPS because you get an option to invest in equity.
Yes.
Okay, and it's going to be a diversified equity, like a normal mutual fund, and you remain invested in that till the age of 60. So today, even though I run my own company, I contribute to NPS because it saves taxes for me. If I have to remove money from my company as salary, that salary gets taxed, right?
Yeah.
So for me to save tax, if I can contribute directly to NPS from my company, that income is not taxed. Okay, and at retirement, I will receive 60% of that money tax free. So, so that's why it becomes very important, because your money will get 25 years or more to compound.
Yeah.
At the same rate of return which the stock markets will generate, and you will save maximum amount of taxes on day one as well. So taking money in your bank account as salary and then investing in mutual funds or investing in NPS and saving taxes, NPS is better to the extent of the amount of taxes you can save.
Okay. And now, I want to move towards SWPs. There's been a lot of myth around SWP. I personally don't know much about SWP because of the stories that are going around that you need this much capital, which is in lakhs, right? Can you put some light on what exactly is a good amount to invest in SWPs so that you can withdraw every month?
So SWP as a product has been oversold firstly.
Okay.
SWP is just a mechanism to withdraw money from mutual fund. Okay.
Yeah.
It is not retirement plan.
It's self-explanatory, right?
Yeah. Systematic withdrawal plan. It is not retirement planning.
Yes.
There is a lot more to retirement planning than just doing SWPs.
So is it a post-retirement planning or something of that sort, or pre-retirement planning?
Like I said, SWP is just a tool to withdraw money.
Yeah.
Without an SWP also, I can withdraw money from my mutual fund in retirement.
Yeah.
I don't have to set up an SWP because I have retired, right?
Yes.
So SWP is just a tool. Now, you might have heard, you might have seen a lot of videos on social media saying that you invest 1 lakh rupees per month, you will have X amount of money after 20 years, and then you can withdraw 6%, 8% of that every year. Firstly, if you consider that your entire corpus in your retirement, okay, you have to understand that there are certain withdrawal rates that have, there are certain withdrawal rates which you need to consider when you withdraw money from your retirement corpus. Okay, depending on how much money is allocated to equity, fixed income, that withdrawal rate is decided. Okay, so the average withdrawal rate in the West, which they have followed, is 4%. Okay, but now that has come down because of studies that have happened over time. And India also, it's around 3.3% to 3.5%. So anybody telling you that if you have a corpus of 1 crore after 20 years, you can withdraw 1 lakh per month, 75,000 per month, basically they're saying that you can withdraw 9 to 12% of that corpus. Now imagine that 1 crore staying invested in Nifty, and Nifty was at 26,000 in September 2024 and Nifty is at 24,000 today after almost 2 years. That 1 crore firstly would have come down by 10% to 90 lakhs because Nifty fell down by 10%, and then you would have withdrawn 12% each year. Yeah. That's another 24% withdrawal. So 90 would have come down to around 65 lakhs, right? Think about it, how long will this money last? So that's why you need to be very cautious about when you listen to something, question that. Okay, does it make sense? What is he whatever he's saying, this guy is saying, is this true? Does it make sense mathematically, right? Don't just go by what people are telling you on social media.
Okay. So before we wrap up, Niraj, what is that one thing or lesson that changed your perspective towards money or investments?
So personal finance is very simple. Okay, you may not even need a financial advisor if you can understand the basics of personal finance.
Mm.
Okay, and there are probably 3 or 4 pillars of personal finance: risk management,
Mm.
goal-based investing, okay, and income. Right. Cover your risk through various insurances.
Okay.
Figure out your financial goals, how much money you need to invest. Invest in diversified mutual funds, right? And then focus on growing your income. If you can do these 3 things consistently for the next 20, 30 years, okay, till your earning life, and till the end of your earning life, you will make enormous amount of wealth. But you have to stay away from news, you have to stay away from social media, especially financial social media, because every day somebody will scare you and tell you that you have to sell your investments immediately.
And especially with the Telegram groups right now, I feel they are the most educated people out there in with regard to investments.
Yeah, I mean, anywhere, go anywhere, you will see. So even now when gold has fallen, you will hear stories that gold will fall from $4,000 to $3,000. When Nifty was at 22,500, there were stories that Nifty will go to 18,000, 15,000, 12,000, and you would have sold. That is the mistake that people make. If
Markets revolve so much around speculation and rumors, right?
Absolutely. And so what you need to do is mute everything.
Yeah.
Okay, just focus on your work, invest consistently. That's it. Nothing else needs to be done. If you can't figure that out, work with a financial advisor. Right? Trust me, just by investing consistently and increasing that investment every year, you will create so much wealth that you would never have thought about it.
Okay. Thank you so much, Niraj, for your time.
Thank you.
It has given not only me a lot of clarity, but I'm sure even to our viewers that it has given them a fresher perspective about financial planning. Thank you again, Niraj. Thank you so much.